I want to thank everybody for joining us today for this presentation on the EverEdge Intangible Benchmark Index, and presenting this piece of research. And on the call today with us, I'll go over a little bit of the group that we have. We have Katherine Evans, who is a General Counsel for Zespri International. Thank you, Katherine, for joining us. We have Jason Roberts, who's the Executive Director, FinTech New Zealand. And we have Craig Margolius, who is the Head of Transactions for EverEdge, and assisted in writing a bit of the majority of the research, I should say. So thank you, Craig, for your time. I am Tyler Capson. I'm the Managing Director for EverEdge, and pleased to be able to go over this and present this information with you. The run for today's meeting, I'll do a little bit of housekeeping as we kick off this presentation. The run for this is we are going to go a little bit over the research, why we looked at the research, what was its purpose, and then we're going to go into a little bit of the technical review and some of the outputs of it that we found as we did the research. Then we are going to facilitate a panel discussion with some Q&A with our guests, Katherine and Jason and Craig. And then we'll also leave it open for Q&A from the participants. So I'm sure you've all used Zoom and Teams by now on these types of things, but there is two sections. There's a chat function and there's a Q&A function, okay? If you have a question for one of the presenters or about the research, please put it into the Q&A section so that we can make sure that it gets answered as part of the panel discussion. And if you have issues with the webinar, you can put those into the chat function and we'll see if we can assist you on that. But we'll go ahead and kick off, and I'll give you a short introduction of EverEdge and around the reason why we've done this research and sort of our view on the market. So if you haven't dealt with EverEdge before, we say we're an intangible asset specialist. All right, and we have offices in the US, the UK, Australia, New Zealand, Singapore. We've been around for 14 years, and we are a mix of advisory, transactions, evaluation specialists, consultants, and legal and financial firm. All right. And when people ask us, well, what is intangible asset specialist? What does that even mean? I say, well, we help companies walk through this process to help them to identify their assets that they have, the intangible assets that they have, help them to assess the quality of those, and then understand what the strengths of those assets are so they can actually put them into a strategy. We run them through this process, identify, assess, strategize. Once you've got that down, you can then help people to value what they have in their companies. And if you know what it's worth, you can start to actually create a plan and monetize ways to either license it or sell it. And we do all of that with the lens of intangible assets. And when we talk about intangible assets, we're not just talking about, legal assets of intellectual property that most people think about when you think about intangibles and, balance sheet items that end up typically marked as intangible assets, but we're talking about a much broader asset class, everything from confidential information, design, software code, even networks and relationships. And the reason we focus on these is because these are the primary drivers of company performance. They're kind of like the blood that make these companies work and function. And so if you think about intangible assets, really the value that they create in a business, a lot of times you don't necessarily see it. If you take something like a steel mill, okay? The value in a steel mill doesn't necessarily come from having a brick and mortar factory and plant, but it really comes from the ability to know how to create steel effectively, right? How to actually produce steel. And for that, you need quite a bit of things. You need a bill of materials, you need training manuals, you need systems and processes, you need the connections of, even sourcing raw materials. You need a lot of intangible assets to be able to actually end up producing steel safely. And so a lot of times where the real value comes in is not in things that you would typically tend to look at. And an easy way to show this is if you look at Instagram, Originally, this is actually a photo of the original Instagram group when they sold to Facebook for $1 billion. And at the time, I think there was about 14 employees, and they, you know, from a standpoint of valuations and from a standpoint of value, most people would say that it was very hard to value a company at this stage because they had zero revenue, they had very little revenue, they had almost no assets, and they had only 12 staff. And at the time, they were only 20 months old. If you compare a company like Instagram to a company like Main Freight, okay, a large shipping company, they have 1.8 billion in revenue, $1 billion in assets on their balance sheet, over 6,000 in staff, and again, they have the same value of market cap of $1 billion. So from traditional financial analysis, that really shouldn't be possible. That two companies like this are valued the same, where one is completely intangible and other has significant amount of tangible assets. And the reason that you end up seeing this is because tangible assets can't scale at the exponential growth rates that intangibles can. And it's simple, but it's also very profound. And so over time, if you think about tangible assets, the growth of those assets, it's hard to create more of those assets. But when you compare that to intangible assets, you see exponential growth. And a case study to kind of show this is if you compare the agriculture sector to the semiconductor sector from 1970 to 2020. And you look at the vast difference between these two sectors. And it's interesting because there is a limit to the amount of things like grass or trees or the number of cows that you can grow in agriculture. But in semiconductors, there is limitly no law, or what happens is you might have heard of Moore's law in terms of doubling every the amount of output from in the tech space every few years. And in agriculture, you can't just keep adding more cows because you end up running out of land. But you can expand, when you're dealing with intangibles. So effectively, when you think about capital and where people more effectively want to invest their money and put their money, they want to put it after growth. And so by taking things that are infinitely scalable, you have a much better opportunity at expanding your capital or growing your capital. And so what happens is investors have now shifted a lot of their focus to look at companies that possess these types of attributes. And you see, if you look at how long companies took to reach $1 billion market cap in the examples that we've got, almost all the companies on the right-hand side, are tech companies that have utilized intangible assets. Whereas on the other side, a lot of brick and mortar or product companies, it's taken, a long time to reach that $1 billion market cap. So the evidence is clear. Intangible assets have been growing significantly over the past 40 years. And we've seen this research on. And there's a simple way that we've seen this. I mean, there's this graph from Ocean Tomo that showed over the past 40 years, value of intangibles has grown from roughly 17% to over 90% in value. And we know that to be one way to look at this. And so as intangible asset specialists, EverEdge wanted to do a deeper dive into, how can we slice this up and figure out, we know that it's not all sectors, but if you take a broad view of the market, everything gets clumped together. So as investors and as owners of companies, how can we actually figure out which of the individual sectors that are going to have the most growth and the most opportunity? And if we are in something like agriculture, what can we do to still tap into that exponential growth, even if we are in a brick and mortar style of business? So that really was sort of the catalyst behind the the research report, the intangible benchmark index that we've created. So at this point, Craig is the technical expert on this, and he's going to explain sort of the differences of what's been done in the past and the view that EverEdge took to look at this data and slice it up a different way. So Craig, I'll hand it over to you and let you run through more of the findings.
Thank you, Tyler. Tyler, you're 100% right. The amount of effort that went into this report into the detail of this report was significant. And, again, back to, why did we want to do it different? Why did we want to look at this benchmark data differently? And largely it's because, market capitalization conflates operating and financing choices. Simply put, market cap is not a good representation of true value because it does not take into account the debt required to grow that company aggressively. So what you want to do is you want to adjust for the debt, you want to remove the cash and the financing effect of that company to get to a true reflection of the enterprise value. So in essence, what you're doing is you're neutralizing the effect of the financing choices. Then what we've done is we've looked at restating intangible assets to deliberately understand what proportion of those intangible assets are as a percentage of enterprise value. So again, what did we do? Well, we started with this methodology of really unpacking, recalculating the enterprise value. So we didn't just take the enterprise value that the market represented. We went through quite an arduous journey of recalculating the enterprise value, which took into account restating the tangible fixed assets, as well as stripping out the existing intangible assets that were on the balance sheet. So, that involved, unfortunately, and again, quite painfully, I say, we had to drill down into every single company in every single sector and every single index that constructed into the collection of these indices and say, all right, what existing goodwill or intangible assets are there in balance sheet? Strip those out. Recalculate the tangible assets, recalculate the short and long-term debt, remove the financing effect of the debt and the cash, and eventually get back to a restated number. Then ultimately looking at that restated net tangible asset versus the enterprise value, we got back to the implied intangible assets. Now, I mean, again, if you look at Ocean Tomo, they've always done this representation of 90%, of market capitalization, where we're currently sitting at 90%. And they've gone back quite far. But the reality is when you start to go to an enterprise value analysis, the data gets a bit sketchy pre-2000 because a lot of these companies are no longer listed. The indices are no longer a good representation of this, constantly intangible asset-based economy that we're seeing in the United States. So what we've done is we've focused on 2000, 2020, and we've done it every 5 years. So our analysis has gone from 2000, 2005, 2005, 2010, and so on. Okay. So what did our benchmark index analysis find? And that's fairly well represented there, is that when you look from 2000 at 78%, dipped down to 72%, and then it's been climbing ever since. So yes, while the number seems lower, the granularity that we've achieved by looking at the specific sectors in each of these global indices is a much fairer representation. And we'll start looking at each of these in a bit more detail shortly. I'll get to the next slide. Sorry, gone one too far. So, what was also a bit different, so outside of just the methodology of calculating enterprise value and restating these intangibles, there was another trick in what we try to unpack here, and that was back to the GRCS, what they call the MSCI GRCS index classification, of which there are 11 sectors. The reason that's important is that, to your point earlier, it's, well, where do we see the outperformance of intangible assets and which sectors are lagging behind? And you can see we then did it for the 4 main indices we wanted to cover, using the US as, the guiding light or principle of an economy that's largely intangible asset driven versus the New Zealand All Share Index, the ASX 200, and the FTSE ST All Share Index. It's important to note while we're going through as well, when we went to the index analyses, we did reweight. So we neutralized the effect of significantly larger companies or smaller companies by reweighting them in and amongst their peers. So it is it's an EV weighted adjusted valuation or representation of that percentage. Okay. So again, looking at the S&P 500, it's no surprise to see our IT and the healthcare sectors, outweighing in terms of intangible asset performance. It's important to note that out of 11 sectors in the US, 7 of these, so outside, except for 4, 7 all had an excess of 90% intangible asset value. So that's an outlier compared to all other indices globally, right? And the only sectors that seem to underperform in the US from an intangible asset point of view, utilities, energy, financials, and real estate. But outside of that, the other 7 all had an excess of 90%. So what you're seeing play out in the US is just the strength of the intangible asset-based economy, the fact that that attracts capital, attracts investors, that in turn attracts more companies seeking out capital. And it's almost a self-fulfilling ecosystem where high growth entrepreneurial companies seek investors and investors are seeking similarly companies in this market. And when you see our adjusted numbers from 2000, it goes from 78%, dips a tiny bit, pre-GFC, post-GFC, it starts to regain momentum and it's back up to 85%. Obviously largely dominated by the FANG stocks. Getting to the S&P ASX 200, generally a low overall score. It's been pretty neutral, under 60% since the study has begun. That's largely driven by an overweighting to financials and material sectors. The Australian economy is still largely a mining and material or industrial economy, and that tends to pull it back. What it is doing, unfortunately, is when you look at it at a collective view, it's hiding the fact that there are some shining stars in the IT and healthcare space. And we've seen a whole spat of listings in the last 5 years. So there's an aggressive focus on these companies coming up. Unfortunately, what we're seeing though is when they reach a certain stage of maturity, unfortunately, they are acquired by US or European-based economies and they just remove them from the exchange. And this is also playing out in the New Zealand market as well. A bit of a lag changing slides, excuse me, it's coming. Okay. When we look at the NZX All Share Index, it's interesting to note that from 2002, when the index was constructed until today, they're the same 116 companies. There are a few changes, but the total count is 116 companies since inception. There's been a consistent rise in intangibles over the last decade. Now, what has driven this? Largely has been driven by a few key players. So when you unpack the IT space or consumer staples, or even healthcare, for example, what you'll find when you get into the real detail is it's one or two key companies like the Fisher and Paykel's of the world. What's also a bit of an anomaly in the New Zealand context is the energy stocks. The energy stocks appear on the surface to have very high intangible asset percentage relative to their enterprise value. Now, you could say, well, are those really intangible assets? What is playing out there? And our general observation was that it's been driven by shareholders seeking yield. And in a low interest yield environment, what's happened is all investors have been investing heavily in the energy stocks just to extract dividend yield out of those companies. This in turn has driven up valuations of the energy stocks. What's also a key factor of the New Zealand economy is just access to capital is lacking, and that continues to be a constraint on the ability of entrepreneurial, innovative companies that focus heavily on intangibles attracting that capital. And we're seeing that play out in terms of a lot of the companies either leaving the NZX, going to the ASX, or even selling out early on in their growth curve, not even considering an IPO and going to foreign markets. And again, that's represented by the fact that in more than 18 years, this index has constructed the same 116 companies on exchange, and there hasn't been much change in that space. Bit of a cautionary tale though when you get to the FTSE ST All Share Index, which is a representation of Singapore. So this index construction basically includes 98% of all the companies that are of a certain quality on the Singapore exchange. I think the most important number that's not represented on the slide in terms of the weighting of intangibles is the fact that from 2008 when the index was constructed until 2020, you can just see that decline down to 28%. But here's the most important number. In 2008, there were 265 companies listed on this exchange. Today, there are 105. That's a net loss of 160 companies that have delisted. So again, we say this is a cautionary tale for the NZX and the New Zealand economy of what happens. Does it mean that intangible asset-rich companies aren't attracting capital? No, they are. The point is that they are now listing on the US exchanges or other European or even potentially the ASX exchange. And in direct, what's happening is retail investors that just do not have access to assets of this quality. So, and then to make matters worse, when you drill down on the All Share Index, you start to notice of the 105 companies that are sitting in that 28%, here's the real problem. 47 of those companies are property companies. So again, a cautionary tale for property and asset-rich, markets where, you start to basically export all your IP too cheap to countries that respect and value that intangible asset. So, just closing off, just next slide as we go through. Oh, that's it, Tyler. That's it from my side. Hand you back to Tyler.
You can't leave it there. All that technical, Now I want to ask you a ton of questions.
I know.
So. All right. Hey, thank you, Craig. I really appreciate that. And the reason why, we've delved into that is because we wanted to see if there was takeaways. We want to see what would come out as we started to pick apart each of these industries individually. And so some of those things that really developed or that came out through the process was this. First of all, intangible assets, are very important. We've seen that, research done by NYU, McKinsey & Co., Ocean Tomo, and now, EverEdge. We've lived this for the last 12 years. We know that this industry is growing because we've seen the growth. But it's about people understanding the using those terms and looking at their business with that lens is something that we're really only seeing in the last sort of 3 to 4 years on a serious movement. And so secondly, companies that harness inherent scalability of these assets grow faster. That's almost an easy thing to say. Well, if you are looking to generate or create a platform that is scalable, then of course you're going to grow faster. But really is that, the broad findings across this is that EverEdge has done, 2,000 engagements over the last 14 years. And it's not just those companies that look at scalability to grow faster, but a lot of times we see, okay, what is their competitive edge or their unique advantage, or what are the moats that they've created? And those are the things that then they use different terminology, but end up being the same thing. It all kind of comes back to intangible assets. And the last piece is what really prompted us to set up this webinar, is to explain, okay, so if that is the case and capital chases growth, effectively then capital is really chasing intangible assets. So how do we identify those, and how do we get more companies to see, oh, these are our intangibles, and therefore we need to then put a label on these to go out to the market to hopefully attract that. So companies are, comprehensively identifying their intangible assets, and we see them that if they deploy them in their scalable business, they don't only perform better, but they're able to articulate those assets to external investors better. So it's not just about having them, but it's about how you can actually explain those out to increase shareholder value. Now, here's a quick diagram. It's very, very simple, but typical way to attract capital, right? You identify a company or a business, an idea, something, okay? You go out and you start to do it. You deploy it. You say, okay, we're going to go ahead and we have a new way to a new way to create a product. Okay, you're going to go out and create that product. You get the materials, you get the machines, you get the factory, and then you go out and you start to grow. You sell the product and you do another factory, and then you have another retailer, and then you grow retailers from there. So you grow your business through that method. Once you start to grow and you're out in the market, people go, oh, okay, let's give them capital because we see where it's going to go. And that is one way to do it. Companies that can articulate their intangible assets early on can pass through a lot of this in terms of, once you've identified what you have, if you can articulate to the market why it's unique and why it's different, and say, well, the sector is going this way, but we have a unique advantage that's a little bit different from the sector. So therefore, we're different, we're better, we're faster, we're stronger, something in that. And most of the time that's going to be through the intangible assets. You can bypass that and go straight to attracting capital. And we're seeing early stage startups taking in these massive, massive amounts of money because we're seeing better articulation of intangible assets in the market, which is one of those pieces that the research is really proving. And so I think from an overall standpoint, that's kind of the piece that we wanted to get out. If you want to attract capital, you can kind of go the long route and build it yourself. You can, but if you understand how to articulate your intangible assets within your business, you can cut that time down significantly. Now, this comes from projects. This could be from a company standpoint, but it can also be from an industry standpoint. So depending on where you are in that spectrum, if you're an owner or an operator or an investor, understanding that the companies that are going to better articulate their value, better identify those intangible assets, are typically a better bet in terms of seeing that scalable and exponential returns, which is what the investors are seeking for. So, so with that, I think it's very. Thank you, Craig, for going over that. And I wanted to open up the floor now. So please, if you guys have questions on this, please put them into the Q&A. And I want to go ahead and start off with our panel here, because I know we've got we do have some questions that we prepared, and I want to give a little bit of time to Katherine and Jason from an industry standpoint, who look at this and from their role, how they have seen that. So I'll start with Katherine first. Let me give a quick introduction as we open this panel. So Katherine Evans, I said, is the general counsel of Zespri. And Zespri is a global leader in Kiwifruit with the purpose of helping people, communities, and the environment around the world thrive through the goodness of Kiwifruit. In her role as general counsel, Katherine provides advice on legal and intangible asset matters across all areas of the business, from cultivating R&D to consumer marketing and sales in more than 50 countries. So thank you, Katherine. Appreciate you joining us today in the webinar. I wanted to start off a quick question to you, and then I'm going to introduce Jason, and then we'll open up the panel. But Katherine, initial insights or thoughts that you had on the intangible asset research, or just in the growth of intangible assets that you've seen, in your role as general counsel for Zespri. And does that align with what you've seen in the industry and what the research kind of presents?
Yeah, thanks, Tyler. Great to be here with everybody today. I guess when I looked at the benchmarking study, I sort of felt, well, it's not really surprising overall to sort of see the capital chasing the growth. I mean, that sort of aligns with everything we all think about intangible assets, and also with that really being dominated in the US, especially from the technology side and things like that. I was a little bit surprised by Singapore. But I think one of the things that kind of leapt out at me as well is there's a trend here that when you look at it the other way and you say it's actually also the intangible assets chasing the capital, and the ability now for intangible assets to go and list on all these other exchanges, whereas potentially in some of the more physically infrastructure-based industries and sectors, it's more difficult for them to do that. And so it's harder, I guess, for a company in the energy sector in Australia to go and list on the US exchanges. You can do it, but it's potentially more complex. I guess for me, there were sort of two other pieces. Was potentially, it does provide a real opportunity, and you've touched on it already, about companies really being able to communicate the value of the intangible assets in their business. And communicating that not just within their own local investment community and capital community, but really taking that message out to the world and saying, you should come and invest in this New Zealand stock exchange, because actually there's some amazing companies on it that have fantastic intangible assets. But then I think the other question for me, and not answered by the survey, and it wouldn't be, was whether potentially as well investors might be underestimating the degree of intangible assets that are actually in those physically more infrastructure-bound companies. And I think in one of your early slides, you made a comment, agriculture can't scale. And that is true to an extent, but with new controlled environment growing systems and things like that, what we're seeing in horticulture is that actually you can scale that really, in a really, really significant way. So it'll be really interesting to see whether, in another 5 or 10 years, we actually do see those intangible asset pieces coming up in those traditionally physically asset companies. And also, I would like to think that between New Zealand's strong tech sector and the intangible assets that are actually sitting in a lot of those New Zealand companies, I'd really love to see the NZX and the capital markets here going and really chasing that growth, and hopefully it'll start to bring that up in future years.
Yeah, well, and yeah, definitely with companies that are leading the edge and pushing the edge in terms of traditional industries, like agriculture and like Zespri, are looking at ways to kind of go into those. So you're absolutely right. And not that you can't scale, it's just that traditionally, and we've seen that over the years, it's been harder too. So you're absolutely dead on and correct. And we'd like to see more of that. And look, Jason, I mean, you're in a FinTech sector. So look, I'm going to introduce Jason Roberts to the panel. Thank you, Jason, for joining us. Jason has been in the tech sector in New Zealand for the last 20 years, mostly specializing in sales, marketing, leadership roles. He's consistently helped companies with digital innovation, implementing new generation technologies, solutions, usually in the SaaS space or vendor environments. He's an entrepreneur by nature, and Jason has bought multiple ventures to market, and in particular advancing SaaS solutions, traversing health, telco, financial services, digital services, and marketing platforms, and been through the excitement and grind of bringing startups through to exit. He also has multiple he has had multiple tech investments, helping other companies with their growth plans, and loves the dynamic and fast-growing pace of the industry. So, Jason, thank you so much. And I'm going to ask you the same question before I get into the other prepared question. Your role and how you see this sort of the tech side in New Zealand, and as in the FinTech side, you're kind of on the other side. Is this the research, does that fit with what you would have seen in your industry experience and the position that you are, and your comments on the research in general?
Tato, thank you very much for your warm welcome, and a pleasure to be here today for EverEdge. Actually, interestingly enough, as you were talking, I was reflecting on my previous experience. I actually came to EverEdge 10 years ago with one of my own software companies, trying to work out how to get basically the valuation of the company as high as I could. So when I went back to my investors, I could get a higher amount of funding. So I think we're all on that journey ultimately, and it's been really interesting. If I reflect back 10 years ago when I was doing that, the investment market in New Zealand was very different from what it is now. FinTech was barely known. If you went anywhere, you went to the ICE Angels, which is what I did. If you had to raise your second round, it was probably with their nominees. There wasn't much private capital. It's pretty hard to jump from an A/B round to a stock market round and then onto international exchanges. That is very different now. And, if I put a lens on FinTech, you've got an incredibly buoyant marketplace. I mean, we're just actually looking at some research just now. The TIN 200 report, which isn't public yet, but will be hopefully soon. The tech sector is number 2 by value for New Zealand exporting, only behind agriculture. It used to be tourism, of course. And much of that tech sector is based on intangible assets. And within that, FinTech is so it's a 5th subgroup, and delivered, I think, I forget the exact number, something like $2 billion growth last year, and 25% growth in 1 year. So you've got certain sectors that are just exploding. And what's coming through is that all of these folk in the tech sector are having to really articulate their value to their investors and the people that engage with them, to understand that they're scalable, that their proposition is quite unique, that it can be taken internationally with relative ease, and that understanding that there is a risk profile, but that can be moderated and made safer. So, the FinTech sector has grown really quickly. InsurTech, which is the other group I founded 5 years ago, wasn't even known about back then. And back then, nobody invested in insurance. I think the latest research, we had a company do a round the other day for 30 million. So we've got these big changes. We've also got this Web 1.2.3 change coming through with the real focus on virtual asset service providers, digital currency, cryptocurrencies. These are all basically high risk in some ways, but really palatable in that they're becoming regulated and understood by the markets, and investors are pouring money in. We've got a Kiwi company, programmable money, they're called Power Finance. They can program their money to show its future value, irrespective of what the stock market might do. And they've just raised 30 million. So we've got this huge amount of stock going in. And then you have companies going, well, what's my best investment pathway? Do I invest in New Zealand? Do I raise capital in Australia, or do I jump to the NASDAQ? And if you look at Xero, they raised in Australia because of their profile and awareness, not the US. Whereas PushPay jumped straight to the US because that's where they started the business. So there are some really interesting dynamics. And I'm no market specialist when it comes to stock exchanges, but really what comes through is, in my view, looking at the research and from personal experiences, you really need to articulate your value, how you're going to deploy your assets, how you can manage your risk with your potential investors, and then how from that you can get the capital that follows behind. I hope that's a helpful start.
Absolutely, absolutely. I mean, and Jason, that's a very good perspective, and some of those examples that you've given are perfect examples of that. Now, look, I'll invite sort of anyone, Katherine, Craig, please join in on this. I think we've determined that, one of the things the research has shown is that capital is definitely chasing this growth. People are trying to find these intangible assets. And, Katherine, you kind of touched this, that, the investors are starting to look at those intangible assets. But I guess open to anyone, that how do you think then the markets and the investors could better factor in the value of intangible assets, as they, from a company standpoint, as an owner operator, how could you factor in, the value of intangible assets in terms of drawing more investment and capital?
Do I jump in and answer?
Yeah, please.
Look, I mentioned it before. It is really about articulating what you've got, and from an investor point of view, really letting them understand. I mean, all companies will help educate their marketplace about their proposition and capitalize, help around risk. I mean, funnily enough, people trust their iPhone platform much more than they trust a bank these days. So, I think there's some really powerful technology conversations going on around who do you trust. And the Web3, funnily enough, the concepts is trust in code and trust in networks and communities, as opposed to platforms like the Apples or the Googles or even regulatory bodies. So there's an extraordinary shift coming this way. And right now, the Review of Money, AML, Counter Financing Terrorism Act, is all about what does the future of money look like and how does technology have a play with it. It's an incredibly exciting world at the moment. You guys have got a hell of a job.
Well, bringing those types of assets in is important, and especially for someone like Zespri. I know Katherine is probably jumping at this, because if you think of, Zespri has an exceptionally strong intangible asset portfolio, and you already mentioned you're kind of coming into this segment. How do you see intangible assets, helping to drive value within the agriculture space and within Zespri and the business, in the next sort of 10 years?
Yeah, I mean, look, obviously the core of our intangible asset portfolio, and the one that I guess everybody kind of immediately jumps to, are the PVRs, the plant variety rights in our proprietary cultivars, and our brand obviously is a very, very significant intangible asset. And I think that's where historically, it's kind of been that's where people understand intangible assets to be. But I think, some of the work we've done over the past couple of years has been very much around really focusing a lot more on those assets that actually aren't so high profile or so easily defined. Really good example of that is the relationships that we have. So obviously our industry structure, that's an absolutely critical asset for us, that we're able to, present a cohesive approach with the industry. That gives us economies of scale that then leads through into value for us, but also for all of our supply chain partners. But even beyond that, we had a really good example this year. Obviously, there was a lot of global shipping disruption, an unprecedented amount, really. And as a result, really, of the longevity and the strength of our relationship with shipping partners, we were able to make changes to our shipping that really delivered massive value to the industry. And if you look at our results this year in our shipping versus some of the other sectors in New Zealand, but even globally, We've definitely been disrupted and we felt an impact, but I think, I don't think anyone would argue that we've actually been able to reduce that impact by virtue of those relationships. So I think, that part of really understanding how the assets all go together, but also, and it's the classic conversation these days about the real value of data, using data across every single segment of our business. So from the consumers and what the consumers want and where their demands are, and, when they eat kiwifruit, where they eat kiwifruit, how they eat kiwifruit, and how they're going to be eating it in 5 years, and rolling that data back, right into embedding it into our plans for our new cultivars, so that we're designing new cultivars and, targeting that demand space for the future. So convenience, for example, making sure that in our cultivar pipeline, the future cultivars have convenience as a critical element. And then, using the agronomic data and all the information we have sitting in the systems around, how cultivars perform, what's happening on orchard, climate data, all of those things really improve the grower experience as well. So that, it's basically improving everything along the chain, which again, it really does come back to that community conversation and that trust, because it's about sort of recognizing that, you can preserve that value and that has a benefit for everybody in the chain. And that actually that's possibly a better way to be viewing it than to be sort of saying, well, this is my value and I'll give it to you if you do what I want. That actually there's an altruistic element to this that I think really resonates, and it's starting to really resonate with investors as well. This idea that companies aren't just chasing profits, that there's a much bigger picture out there for investors to be looking at.
Yeah, I love the fact that you say, the changes that you make, it can help reduce the risks of things like supply chain issues when there's shipping problems, right? And that might be your significant intangible assets. And the way that you said data is actually used to strengthen those customer relationships. If that's a major asset, you're using two intangible assets that work together strongly, that other investors might say, well, yeah, they've got some data, but how are they using it? What is it? And if you can say, well, we're using it to increase the customer relationships, which is also a critical pillar of the business, strengthening supply lines, strengthening shipping dates and timing and all of that with the data. I mean, there's so many elements to that. I mean, we could unpick that for hours. So thank you. That's excellent. Excellent. Craig, I want to jump to you because in this market, we're seeing there's just so much activity. I mean, COVID-19 has really just created a slowdown in certain things like shipping, and logistics, right? But the M&A space is just defied expectations, right? I mean, and is on track to be one of the busiest years ever. What are the trends you're seeing in M&A from your standpoint, that you run transactions and you're running, M&A deals with intangible assets? Are these starting to come on as important assets? When you're working with the deals with your clients, Craig, does it reflect what we've seen in the research as well? And how long do you think those will take to sort of match up?
Yeah, so it's exactly, I mean, you're correct, you're spot on. The M&A space has never been busier. We've never seen more cross-border deals. And I think the interesting things for me is that you're seeing the big multinational corporations coming out of the US, coming out of Europe, trying to acquire intangible asset-rich companies in Australia and New Zealand, but they're almost not revealing why they're doing it. They tend to focus straight in on the historical financials. They tend to focus in on the bricks and mortar type assets. But in the back of their minds, they know exactly why they're doing the deals. And they're almost attuned to the fact that we don't demand high valuations and high multiples in this region, because we look to regional valuations as a proxy for that's what we think we're worth. What that indirectly is telling you is no one's looking in the right place. No one's looking at their intangible assets. They're looking at the balance sheet saying, there's nothing to see here, move on. And in fact, what we like to do from an M&A side and EverEdge is the first thing we do, and it's never too early, is that identification. And identify these intangible assets early and talk to every single one of them at an ad nauseam amount of detail in the sale collateral, in the sale process, in the engagement with potential investors, because this is how you are going to achieve outside multiples. In the absence of that, we're just selling too cheap. And I think that's general feedback on the research when I went into the detail is we tend to price ourselves too low. We tend to blame the fact that there's a lack of capital markets or depth of capital in New Zealand, which I'm starting to say that is not true. You're looking at this entire generation of millennials with access to online share trading platforms. And guess what, guys? They're spending more than they've ever spent, and their money is going overseas. So what we're saying is that you can achieve outside valuations and returns, but you can't arrive into an M&A deal at the end of the process, 10 years into running your company, saying, all right, now I want to do a valuation with EverEdge and just achieve it. You actually have to actively think about how you market and tell the story of each one of these intangible assets to your potential investors or acquirers. And the reality is, the better you are at being a storyteller, the more you will achieve on the other side of the deal. It is about storytelling. Back to what Katherine was saying, whether the trend at the moment, these are all the macro themes you're seeing, whether it's ESG, whether it's the environment in some other shape or form. Actually, what they're saying is articulate your intangible asset better. How does your reduction in manufacturing overheads, cost, labor, how does that manifest into an ESG story that you should be potentially telling investors? If you don't do this, it's a bit too late when you're entering into negotiations, because then you've missed the trick. The trick is be sale ready. The deeper trick in being sale ready is actively think about your storyline, your tagline, way before you enter into a process to start selling off your business or raising capital.
I mean, Jason, what Craig has said is definitely happening in the market. You're seeing, companies get these valuations, and from your side, I mean, the FinTech sector is just booming, right? I mean, it's almost, 100% of value for most companies in the sector is driven by intangibles. How much of that value do you think is kind of being left on the table, or do you think that the companies in this space are able to articulate that? Do you think they're getting what they're worth, from a New Zealand angle, or do you think they're still not quite getting the full value that they should be in this sector?
Yeah, I think we're definitely maturing. That would be the best way to describe it. And some companies are really savvy at it. So we've got to have that kind of international understanding as well. And we have a fast maturing marketplace. I noticed a comment from Adrian on the questions around available capital. There is certainly a lot more pouring, and then the pathway to capital is much easier. And also infrastructure. That used to be the only head startup and incubators. You've got scale up support groups now. You've got Callaghan, you've got Trade and Enterprise New Zealand, you've got free trade agreements with the UK, which are agriculture and FinTech. And so there's a lot of change going on. I just wanted to link a few themes. Katherine mentioned about data before. There's some really interesting stuff. You've got the power of customer experience being a huge differentiator and value, and that must follow the customer journey, customer experience at all data points from onboarding to exit, and that circularity that goes with it. But also just thinking also about international trade. New Zealand's ultimately been a commodity-driven marketplace for forever. And now people are learning that we're not that. We're actually got technology, we've got the likes of Zespri that have IP, or even Gallagher with their electric fences. If you look back 20 years, we've got these really interesting environments now where people begin to recognize the value. So that marketplace is undeniably changing. The deal sizes are getting much larger. But in that, companies are seeing value. Look at a company like Sharesies. They've just, I don't know, I think it was 50 million they raised from an international support. Guess what it's all about? It's about messaging. But they've got 130 customers now who, whilst they don't have their capital in their books necessarily, they have a good runway and foresight about what's coming. And much of the foundation of FinTech is based partly on the technology and platform, but also on their customer base and the growth patterns. And you're going to see that all the time, and it's going to carry on growing. Sorry, I probably said
Oh, you're right. No, it's about that initial early on identification and articulation. Yeah. In the Q&A section, Adrian posted a question for Katherine. Does Zespri have a way of reviewing New Zealand-based technologies that can help them grow globally?
Yeah, thanks, Adrian. It's a great question. I guess I'm interpreting that as helping Zespri grow globally. You may have meant help the technologies grow globally, so I will try and cover off both bases. Zespri is a regulated business, and our core business is under statute regulated as being largely effectively for the benefit of the New Zealand industry. So sort of growing globally as Zespri isn't necessarily one of our core focuses. But we do have production regions offshore, and so absolutely we do look to take our intangible assets offshore, and we replicate our commercial trials and things like that into our offshore production regions. We do a lot of exchange transfers between our teams here and in those countries. As far as sort of growing New Zealand-based technologies and helping those technologies to grow, absolutely, we do have an innovation function here in New Zealand, which has a number of different portfolios. So again, also applied to the business of growing kiwi fruit or selling kiwi fruit, because that is one of our limitations as well, is that sort of wider horticulture space. While we do look at technologies that are sort of generally available for all horticulture, our focus is the kiwi fruit sector. But I guess one of the key pieces would be, again, we have those really, really deep relationships, not only within the kiwi fruit sector. So if it's a technology that's useful for kiwi fruit and could be of use to other horticulture sectors, we collaborate a lot with other people in those communities as well, and obviously generally for the benefit of New Zealand Inc. So certainly I'm always interested to hear about any new technologies that could be of benefit, and always willing to sort of try and use our existing relationships and role as a New Zealand sort of leading company, I guess, to be able to try and benefit sort of other companies in New Zealand that have potential to grow internationally, because obviously that's where we all started. So yeah.
Right. Thank you, Catherine. So another question came in from Jeremy Hall. It says, what role, if any, would you like to see the New Zealand government take in improving the approach to intangible assets? Catherine, why don't you start with this, because you're, in that you probably have the most government regulation across your business, and then Jason, and then Craig, because both of you definitely will have an opinion on this. It's a hot topic right now of what role the government should be taking in things. So let's not let it get too heated. Okay, let's keep it PC. But go ahead, Catherine.
Yeah, so I guess one of the reasons I was smiling is because we're some of you may or may not know, but the New Zealand PBR Act is currently under review, and it's been under review for a while. And one of the sort of challenges we have with that is the importance of ensuring that New Zealand is on a par with other jurisdictions from an intangible asset perspective. So, and that doesn't mean necessarily identical. New Zealand is obviously, we've got our own unique issues, and we need to make sure that we respect those. But I think really reflecting the international world of intangible assets, and as far as possible, trying to align the New Zealand government position with those. A really good example, we've had our PBR infringement case here, and it was fantastic to see the New Zealand courts recognizing. So that was a case where we had infringement of our gold PBRs, and someone purported to license it for all of China. And one of the arguments was, well, actually, the some of the infringing activities occurred in China, and therefore it couldn't have occurred in New Zealand, and so they can't be liable under the New Zealand PBR Act. And it was great to see the courts respecting not an extraterritorial application, but saying, it doesn't make sense that people could get left in the gap between two countries. And so that case is now, they've requested leave to appeal to the Supreme Court. But I think, really that recognition that intangible assets in New Zealand have real potential to be lost overseas, or to lose as a result of New Zealand not having similar levels of protection, and that does have a cooling effect on investment as well. And so it's really important that the government understands and has that really deep understanding of how intangible assets are actually what allow a lot of New Zealand companies to punch above our weight. So I think really respecting that and bringing that through into policy as well.
Yeah, thank you.
I'd like to add also that the financial services is heavily regulated, as we all know. There's virtually nothing you can do. Unlike Australia, where it's thou shall, in New Zealand it's thou should. We're very lucky in New Zealand that we've got less of a prescriptive marketplace. The flip side is that it does hold us back a little bit. I was just actually, while you're talking, just popped up an announcement from the Australian Senate Select Committee, saying they're looking to regulate the crypto economy. Now, that's kind of interesting because that is a virtual asset. It is a risky asset, but it has gone from being outside the realms of regulation to now being regulated, which gives trust. And it gives trust to a whole ecosystem of providers and technology and assets and value, and you just go on and on this. So there is a very important role for the government to help stimulate the market and regulate it, and to give investors, startups, whatever involvement you are in the ecosystem, the understanding of what the market looks like so that you can manage risk and articulate value better. And I think it's really interesting. The governments at the moment are doing a rush of submissions. This is all stuff that's been held back thanks to COVID, but there are two or three really important ones. One's on ESG, around climate disclosure, and that's about reporting directors and officers kind of stuff, but will help improve that area of the marketplace, and will improve the tech systems that are involved around the tangible value of what ESG principles look like in business. But then you've got the AML CFT that I mentioned before, and also the future of money, which is around regulating cryptocurrencies, virtual assets. And once that happens, you're going to get a new ecosystem of environment growing. So what does that look like in terms of the growth of FinTech? So the government's got a really big role, but it also has to give enough freedom for companies to experiment and to take it to the edge. And I particularly like what the FMA have done, where they provided this interface with the Financial Markets Authority. So you can come with your cunning plans, and within literally a couple of weeks, have them proof tested, checked. And we don't have sandboxes in New Zealand, but internationally they have a similar concept. But in New Zealand, you can actually talk face to face with a regulator. And I think we're very lucky to have that. In Australia, you cannot get near a regulator face to face. You just literally have a box of rules and that's it.
Craig, your side. Should government give more rules or less rules from valuing and transacting intangibles?
One simple word, actually, and that's labour. And what that means, and it probably affects you mostly in FinTech, and I think it's affecting the agri space as well, it's just access to the right skilled labour. We seem to underprice our human intellect as a country from a government standpoint, not from anyone else. Private sector seems to get it. And I think it's the biggest threat. And again, Singapore being the cautionary tale as well, like I said earlier, we have this distortion where we regulate access to property if you're a foreign investor, but we don't have any regulations around access to our IP, other than a little bit of tax on the way out. So my biggest fear, where I'm seeing a lot of buy-side M&A cross-border coming in, sucking up our resource, inability to bring in skilled laborers or incentivize them or motivate them to come across the border, you start to worry about. And this, by the way, existed pre-COVID. COVID's just made it worse. I would have to say it's labor, and the ability to grow that human intellect and IP in this country is our biggest threat. To Jason, your second biggest GDP of New Zealand right now, second biggest contributor to GDP. That is at risk. No one's looking.
And our biggest threat for FinTech is talent. But actually, the one thing I bring up is, I know with my own business, how do you protect your IP? Because when it comes to a court case, I had an Indian company want to buy our business. I couldn't share my IP with them properly for fear of them reverse engineering it. I don't know how you fix that. But that is a challenge for us, and it has to be more than just the technology. It's your customer base, it's customer experience, it's data, it's all of these other elements that have to add value and risk protection to your core proposition.
Yeah. Look, in terms of time, I think we're running towards the end of the time allotted for the webinar. Jason, just to finalize on that, look, yes, everyone needs to be looking at their intangibles. How do they protect them? How do they value them? And, if they can do that properly, you have a better chance of scaling your business and attracting better capital, attracting better growth, attracting better talent. So take that on. If you want more information around this, of course, and you haven't had access to the report, please, you can go on to the EverEdge website and download the report. There's also videos on all of those types of topics around identifying intangibles, protecting intangibles. You can talk with one of our specialists. So thank you everybody for joining today. We really appreciate your time, and a very special thank you to Jason, Katherine, and Craig for your time on the panel. And thank you everybody, and have a great week, and We'll talk to you again when we release the next version of the research report.
Well, thank you.
Thanks, everybody.
Thanks, Tyler.